Hello everybody. This video explains accounting concepts. Accounting concepts are rules of accounting that should be followed in preparation of all accounts and financial statements. There are a number of accounting concepts. Some fundamental accounting concepts are explained as follows. First, accrual concept or matching concept. Income and expenses must be recognized in the accounting periods to which they relate rather than on cash basis. 12 months income should be matched with 12 months expenses. Illustration 1. This company received 12 months income at first year, but paid 11 months electricity expenses at first year. That means 1 month electricity expenses for first year was paid at second year. Accrual expenses adjustment is required to add 1 more month electricity expenses so that 12 months electricity expenses is matched with 12 months income. Illustration 2. This company received 12 months income but paid 13 months insurance expenses at first year. That means 1 month insurance expenses was prepaid for second year. Prepayment adjustment is required so to reduce 1 month's insurance expenses so that 12 months insurance expenses is matched with 12 months income. Example 1. Accountant of Star Company discovered rental expense for December year 2010 was outstanding at year end. The company has paid only 11 months rental expenses during the financial year. An adjustment for December year 2010 rental expense should be made so that 12 months income matched with 12 months rental expenses. An accrual expense account is created. Accrual expenses are current liabilities of the company. According to golden rules, addition of expenses, that is the rental expenses, should be on the debit side. Addition of liability should be on the credit side. The journal entry is debit rental expenses 1,000, credit accrual expenses 1,000. Then follow this journal entry to post to the ledger accounts. Debit rental expenses 1,000. Credit accrual expenses 1,000. Example 2. The accountant also discovered 800 salaries was prepaid for January next year. The company has paid 13 months salaries during the financial year. An adjustment for the prepaid salaries should be made so that 12 months income should be matched with 12 months salary expenses. A prepayment account is created. Prepayments are current assets of the company. So according to golden rules, addition of assets, that is prepayment, should be on the debit side. Reduction of expenses, that is the salaries, should be on the credit side. The journal entry is debit prepayments 800, credit salaries 800. Then follow this journal entry to post to the ledger accounts. Debit prepayment 800. Credit salaries 800. So the salary expense to profit and loss account now is 34,100 minus 800 equal to 33,300. Prudence or conservative concept. Revenue and profits are included in the financial statements only when they are realized or there is reasonable certainty of realizing them, to ensure revenue and profits are not overstated. Liabilities and expenses are included when there is reasonable possibilities of incurring them, to ensure liabilities and expenses are not understated. Example: AAA company bought a plant for 1 million at beginning of a financial year. At year end, the value of the plant has increased to 2 million. AAA company cannot include the increased value of 1 million, that is 2 million minus 1 million, as profit because AAA company still holds the plant for production. The increased value has not been realized. If AAA company sold the plant for 2 million, now the increased value is realized. Profit of 1 million can be included in the financial statements. Accountant of AAA company estimate that 1% of debtors would become bad in year 2010. Debtors amount to 10,300 at year end. That means AAA company has the possibility of incurring some bad debt expenses because 1% of debtors may not be able to repay their debts to your company. According to Prudence concept, AAA company should create a provision for bad debt expense in the profit and loss account and a provision for bad debt in the balance sheet to reduce the amount of debtors. According to golden rules, addition of expenses should be on the debit side. That means provision for bad debt expense should be on the debit side. Reduction of assets should be on the credit side. Provision for bad debt on balance sheet reduce the amount of debtors, so it is on the credit side. The journal entry should be debit provision for bad debt expenses 103, credit provision for bad debts on balance sheet 103. Calculation of this figure is equal to debtors 10,300 times 1%. Then follow this journal to post to the ledger accounts. Debit provision for bad debt expense 103. Credit provision for bad debt on balance sheet 103. This is the extract of the balance sheets. It shows the debtors 10,300 less provision for bad debts 103 equal to 10,197. That means the company can collect this amount from its debtors. Consistency concept. It means once you adopt an accounting principle or method, continue to follow it consistently in future. Example: AAA company has adopted straight line method for calculating the depreciation of machinery. AAA company continues to use this method consistently in future financial years. AAA company cannot use straight line method for calculating depreciation in this year, and then use reducing balance method in another year. Going concern concept. It assumes that a business will continue to operate indefinitely. The business will not have to sell its assets anytime soon, and it will meet all its obligations as well. Materiality. Minor events may be ignored, but the major ones should be fully disclosed. Materiality is relative to the size and particular circumstances of individual firms. Example: AAA company bought a pencil sharpener for $100. Although it can provide benefit to the company for 10 years, it will treat as an expense. No depreciation will be provided. The amount is immaterial. Gold company is a big company with sales revenue over 10 billion each year. The accountant of gold company discovered salaries of 10,000 was mistaken as sundry expenses. When compare this mistake 10,000 with sales revenue 10 billion, this mistake is ignored in the profit and loss account as it is immaterial. Same mistake happened in silver company. Silver company is a small company with sales revenue of around 500,000 each year. When compare this mistake 10,000 with sales revenue 500,000, adjustment for this mistake should be made as the error is material in view of the size of silver company. Historical cost. Assets are recorded at historical cost, that is, the original cost incurred in the past to acquire the assets. For example, AAA company bought a building for 1 million 10 years ago. Even though the building is now worth 5 million in the market, AAA company cannot record this building at 5 million. The building should be recorded at 1 million in the account. That is its historical cost. Hope you guys understand accounting concepts. Thanks for watching.